The cracks in the UK housing market are no longer hidden, they're widening by the day. Streets, once filled with bidding wars, now echo with silence as for sale signs gather dust. Behind the calm exterior lies a storm of rising interest rates, falling demand, and investor panic. Families are struggling to keep their homes, landlords are abandoning the market, and developers are halting projects mid-construction. What was once Britain's strongest symbol of stability is now turning into its biggest financial risk. The latest data reveals a chilling truth. The UK property market stands on the brink of collapse.
Number 1. Rising interest rates squeezing borrowers. The United Kingdom is facing one of the harshest housing affordability crises in modern history as the Bank of England's interest rate hikes ripple through the economy. Homeowners who once enjoyed ultra-low fixed rates are now being forced onto far higher variable rates, sometimes doubling their monthly mortgage payments. This surge has placed immense financial pressure on families, particularly those who purchased during the pandemic boom when property prices peaked. The result is a growing sense of fear and instability across the market, with buyers retreating and sellers cutting prices to attract limited interest. The shock is especially visible among first-time buyers, who find themselves completely priced out. The average household now needs more than 9 times their annual income to afford an average home, a ratio not seen since the pre-2008 crash era. Lenders are tightening their standards, meaning fewer approvals and slower approvals for mortgages. The ripple effect is freezing movement in the market, creating a standstill where both buyers and sellers hesitate to act. This paralysis feeds the cycle further, amplifying uncertainty and reducing overall liquidity in the housing ecosystem. Economists warn that these conditions are not temporary, but the early stages of a prolonged correction. As household budgets shrink under rising costs of living, mortgage arrears are expected to surge throughout the next quarter. Analysts from multiple financial institutions now suggest that property prices could fall another 10 to 15% if rates remain elevated into next year. The government's limited response and the central bank's focus on controlling inflation leave little relief for borrowers. What was once considered a stable investment is rapidly turning into a financial burden for thousands, marking the beginning of a painful adjustment across the UK property landscape.
Number 2. Record-high mortgage defaults. Across the United Kingdom, the number of homeowners falling behind on their mortgage payments has reached alarming levels, signaling deep cracks in the housing market. The latest data from UK Finance shows mortgage arrears at their highest point since the global financial crisis of 2008. Many borrowers who fixed their rates during the pandemic are now emerging from those deals into a new reality, interest rates 3 to 4 times higher than before. For thousands, this sudden spike in monthly repayments has become unmanageable, leading to missed payments and the growing threat of repossession. Banks and lenders are tightening their risk models, preparing for a potential surge in defaults. Financial institutions are increasing provisions to cover losses, echoing the cautious stance seen during the last major recession. The problem extends beyond individual borrowers, it's eroding confidence across the financial system. Buy-to-let landlords, once confident in consistent returns, are abandoning the market as higher mortgage costs erase profits. This wave of distressed sales is adding downward pressure on property prices, flooding the market with undervalued homes and further destabilizing overall valuations. For many experts, these defaults are not just isolated incidents, they represent a systemic shift in the UK's housing economy. A growing number of middle-income families now face the same financial strain once confined to low-income households. This shift illustrates how deeply interest rate policies are reshaping economic security across all social levels. Analysts predict that unless substantial relief measures are introduced or rates begin to fall, mortgage arrears will continue to climb into the next year. The combination of unaffordable debt, falling property values, and waning consumer confidence paints a grim outlook, positioning mortgage defaults as the central force behind the coming collapse of the UK property market. Number 3. Sharp decline in housing transactions.
The UK property market is now experiencing a dramatic slowdown in housing transactions, a clear sign that both buyers and sellers have lost confidence. According to data from HMRC and Zoopla, sales volumes have dropped by almost a quarter compared to last year. Estate agents across the country report listings remaining stagnant for months, even when sellers reduce prices. Buyers are becoming increasingly cautious, fearing that prices have not yet reached their lowest point. This standstill reflects a deeper problem. The market is frozen by uncertainty, where no one wants to make the first move and activity continues to decline. For those trying to sell, the challenge is daunting. Many who bought properties at inflated prices during the pandemic boom are now discovering that their homes are worth significantly less. Sellers reluctant to accept losses keep their listings overpriced, which further drives away potential buyers. The lack of affordability combined with high mortgage rates has created a wide gap between what sellers expect and what buyers can realistically pay. This mismatch is paralyzing the market, leading to a record low in completions and stretching the average selling time to the longest it has been in over a decade. The decline in transactions also carries broader economic consequences. Lower sales mean reduced stamp duty revenue, weaker construction demand, and fewer job opportunities in sectors tied to real estate. Analysts describe this phase as a silent contraction, one that doesn't create headlines like a crash, but erodes the foundation of the market from within. As liquidity dries up, even minor economic shocks could accelerate the downturn. The housing market thrives on movement, and with that movement now stalling, the UK property system is edging dangerously close to full-scale collapse.
Number 4. Overvalued properties and price corrections. For years, the UK housing market has been inflated far beyond the reach of ordinary incomes, creating what many economists now describe as a dangerously overvalued bubble. Property prices have grown nearly twice as fast as wages since 2010, leaving affordability at its weakest point in modern history. Analysts estimate that average homes remain 20 to 30% overvalued compared to fundamental income ratios, making a correction not just possible, but inevitable. As interest rates and inflation bite deeper, that long-ignored imbalance is now forcing a painful adjustment. Buyers are stepping back, waiting for better deals, and sellers are reluctantly cutting prices in fear of missing the window to sell. Major cities like London, Bristol, and Manchester are already feeling the strain. Once booming markets are witnessing sharp drops, with some areas seeing 10 to 15% price declines in under a year. Properties that once sparked bidding wars now struggle to attract a single viewing. Many homeowners who purchased during the pandemic are discovering that their equity has vanished almost overnight. This growing wave of negative equity is amplifying anxiety across the sector, especially for younger homeowners who entered the market at inflated rates, believing prices would never fall. Their vulnerability is now feeding a wider loss of confidence. The correction underway is more than a natural cooling, it's a structural reset. Decades of cheap credit, speculative buying, and foreign investment created unsustainable demand. As those pillars collapse, so does the illusion of endless growth. Economists warn that price declines could accelerate if unemployment rises or if mortgage renewals continue at current levels. The psychological shift from seeing property as a guaranteed investment to viewing it as a risky asset marks a turning point. The UK housing bubble is no longer expanding, it's deflating at a pace unseen since 2008, signaling the market's most serious correction in over a decade.
Number 5. Surge in rental prices and unsustainable yields. The rental market, once a stable fallback for investors and tenants alike, has spiraled into crisis mode. Over the past year, rents have soared by more than 12% across major UK cities, pushing affordability to the breaking point. London, Manchester, and Birmingham have seen record-high rental costs, leaving young professionals and families struggling to keep up. This surge might appear positive for landlords on the surface, but the reality is far more complicated. Behind the rising rents lies a system under pressure, one where increasing mortgage rates, maintenance costs, and tax burdens are eroding profitability faster than rents can rise. Many buy-to-let landlords are now discovering that their yields no longer justify the risk. With interest payments eating into profits, a growing number of investors are selling their properties, reducing the already limited supply of rental homes. The government's new regulations, from energy efficiency requirements to higher tax obligations, have only accelerated this exodus. As landlords exit, fewer rental listings are hitting the market, causing competition among tenants to intensify. The result is a vicious cycle. Fewer available homes drive rents higher, but higher rents push more tenants into arrears, increasing overall market instability. This imbalance has far-reaching consequences. For tenants, renting has become nearly as unaffordable as buying, leaving many trapped in precarious living situations. For investors, the supposed safe haven of property is turning into a financial trap where costs outweigh returns. Economists warn that this unsustainable pattern cannot last much longer. The pressure on renters and landlords alike is feeding into the broader collapse of the property ecosystem. As rental yields decline and affordability worsens, confidence in UK real estate as a reliable investment continues to crumble, marking another step toward the impending housing market breakdown.
Number 6. Decline in foreign investment. Foreign capital, once a powerful driver of the UK property boom, is now retreating at a rapid pace. For more than a decade, international investors from China, the UAE, and Hong Kong treated London and other major cities as safe havens for their wealth. However, the post-Brexit climate, rising interest rates, and a volatile pound have transformed that perception. Official data now shows a steep decline in overseas property purchases, with high-end London sales down nearly 40% compared to pre-pandemic levels. The UK is no longer seen as the stable, high-return market it once was. Global investors are shifting their focus to regions offering stronger growth and lower regulatory risks. This withdrawal has left a visible gap in demand. Luxury developments that previously sold out before completion are now sitting half-empty, forcing developers to offer steep discounts and incentives to attract buyers. The absence of foreign capital also impacts local markets indirectly. It reduces liquidity, suppresses prices, and discourages further development. Many regional cities that benefited from overseas investment, such as Manchester, Liverpool, and Birmingham, are now experiencing a sharp slowdown in property appreciation. Developers and estate agents who once relied on this steady influx of cash are struggling to stay afloat as deals dry up. The ripple effect extends far beyond property sales. The construction sector, financial services, and even local councils that depended on transaction revenues are feeling the strain. With fewer foreign buyers injecting funds into the economy, the property market is losing one of its strongest historical pillars. Analysts warn that without renewed international confidence, recovery will be slow and fragile. The decline in foreign investment not only underscores the loss of global trust in the UK's stability, but also serves as a clear warning sign that the foundation of the housing market is steadily eroding.
Number 7. Construction industry slowdown. The UK construction industry, once a strong engine of economic growth, is now grinding to a halt under immense pressure. Developers are pausing or canceling projects as rising interest rates, material costs, and labor shortages make new builds increasingly unviable. Data from the Office for National Statistics shows that construction output has fallen sharply over the past year, with housing completions dropping to their lowest point in more than a decade. The combination of higher borrowing costs and weaker buyer demand means developers can no longer justify large-scale investments. What was once a booming sector is now facing a dangerous contraction that threatens jobs, supply chains, and future housing availability. This slowdown isn't just about numbers, it's about confidence. Builders who once operated on tight but profitable margins now face losses on projects started before costs skyrocketed. The price of raw materials, from concrete to timber, remains stubbornly high due to global supply disruptions. Meanwhile, the shortage of skilled workers has pushed wages up, compounding overall expenses. Developers are caught between two crises: falling property values and rising input costs.
costs. Many are choosing to halt construction entirely rather than risk finishing projects that may not sell, creating ghost sites across the country and leaving half-completed structures as silent reminders of a market in distress. The implications of this slowdown reach far beyond the construction sector. With fewer new homes entering the market, supply shortages are expected to persist even as demand weakens. This imbalance will continue to distort prices and rents, hurting both buyers and tenants. Economists warn that if the industry fails to recover soon, the long-term damage could mirror that of the 2008 housing slump. A stagnant construction sector means fewer jobs, reduced tax revenue, and a prolonged property downturn that could define the next decade of Britain's economy.
Number 8. Government policy failures. For years, inconsistent and short-sighted government housing policies have contributed to the instability now shaking the UK property market. Successive administrations have made bold promises, from Help to Buy to First Homes and stamp duty holidays, yet each initiative has offered only temporary relief while inflating prices further. The failure to address the root causes of affordability has left the market dangerously exposed. By encouraging demand without solving supply shortages, the government inadvertently created an artificial bubble. When interest rates rose, the illusion of stability shattered, leaving both developers and buyers stranded in uncertainty. Investors have lost faith in long-term housing strategies. Policy U-turns on rental reforms, tax reliefs, and planning laws have created confusion and hesitation across the sector. For landlords, shifting regulations have eroded profits. For developers, bureaucratic red tape continues to delay planning approvals. The absence of coherent direction has discouraged new projects at a time when they're most needed. Even local councils, overwhelmed by inconsistent funding and limited authority, struggle to meet housing targets. Every delay, reversal, and broken pledge compounds the perception that the government lacks a sustainable vision for housing, deepening the market's structural fragility. This policy paralysis has wider economic consequences. As confidence fades, foreign investors retreat, construction slows, and mortgage markets tighten. Without a unified strategy to restore balance between supply and demand, the crisis will only intensify. Experts warn that ad hoc incentives and short-term fixes can no longer sustain the property system. What the market needs is stability, yet what it continues to receive is confusion. The government's failure to implement consistent, forward-thinking reforms has transformed housing from a pillar of financial security into a symbol of dysfunction, a sector where poor governance now stands as one of the central drivers of collapse.
Number 9. Economic stagnation and inflation. The UK's broader economic stagnation has become a powerful force dragging down the property market. With inflation stubbornly high and real wages failing to keep pace, household purchasing power has collapsed. Everyday costs for essentials such as food, transport, and energy have soared, leaving little room in family budgets for mortgage repayments or property investment. As disposable incomes shrink, consumer confidence plunges, and when people feel poorer, they stop buying homes. The once thriving middle class, the backbone of property demand, is now retreating from the market, triggering a chain reaction across every layer of the housing economy. High inflation doesn't just hurt buyers, it also reshapes lending behavior. The Bank of England's monetary tightening aimed at controlling inflation has made borrowing vastly more expensive. Small businesses dependent on credit are cutting back, unemployment risks are rising, and market sentiment remains fragile. With economic growth stagnating near zero, few sectors can offset the slowdown in real estate. Even renters, once thought to be immune to mortgage trends, are suffering from wage stagnation that prevents them from meeting escalating rent prices. This dual pressure, stagnant income and rising costs, is eroding both housing demand and investor appetite simultaneously. Analysts warn that such conditions create a feedback loop difficult to escape. As fewer homes are sold, construction slows further, reducing jobs and spending power across the economy.
Falling house prices, in turn, reduce household wealth and discourage consumer spending, amplifying recessionary pressure. The property sector, which historically stimulated recovery, has now become an anchor weighing down growth. Economists caution that without decisive fiscal measures to stimulate real income growth, inflation and stagnation will continue to feed a slow-motion collapse, one that could redefine the UK housing market for years to come.
Number 10. Investor exit and institutional sell-offs. A growing exodus of property investors is now amplifying the downturn across the UK housing market. Large institutional funds, pension investors, and real estate trusts are quietly offloading assets to limit exposure to falling prices. What began as cautious portfolio trimming has turned into a wave of mass sell-offs, releasing thousands of units back onto the market simultaneously. These forced liquidations are driving prices even lower, triggering a cycle where falling valuations prompt more investors to exit. For the first time since the 2008 crisis, institutions once considered long-term stabilizers of the market are actively contributing to its decline. Smaller landlords are following suit. Rising mortgage costs, higher maintenance expenses, and strict tax policies have stripped away profitability, leaving many unable to sustain ownership. As investors dump properties, buyers remain hesitant, creating an oversupply of listings and undersupply of confidence. Developers and agents are caught between plummeting demand and growing inventory, making it impossible to maintain price stability. This sudden reversal has crushed sentiment across the sector, turning what was once viewed as a low-risk investment into a volatile gamble. Even commercial real estate, from offices to retail parks, is suffering similar distress, deepening fears of a broader financial contagion. The consequences of these sell-offs reach far beyond the housing market. Local economies dependent on property-related activity, from construction jobs to legal services, are shrinking under the pressure. Meanwhile, ordinary homeowners face the painful reality of negative equity as their property values fall faster than their debt. Analysts predict that if institutional withdrawals continue through next year, Britain could face one of the most severe property downturns in modern history. The investor retreat is not just a symptom of the crisis, it is the final accelerant pushing the UK property market toward full-scale collapse.
The signs are undeniable. The UK property market is standing at a dangerous crossroads. What began as a slow correction has evolved into a full-scale structural crisis driven by rising interest rates, economic stagnation, and collapsing confidence. From homeowners struggling with unaffordable mortgages to investors offloading properties in fear, every layer of the system is showing weakness. The illusion of endless growth that fueled the housing boom for decades is now breaking apart. As prices fall, transactions freeze, and foreign capital retreats, Britain's once dependable property sector faces a reckoning that could reshape the nation's financial future. If you found this analysis valuable, make sure to like the video, subscribe to the channel, and turn on the notification bell so you never miss the latest updates on the housing and economic crisis. Share your thoughts in the comments. Do you believe the UK housing collapse is just beginning, or has it already arrived? Your opinion matters.